Welcome to This Explainer. I am absolutely thrilled to have you here today, because we're about to step into the shoes of a forensic accountant. We're going to unravel a massive mystery hiding in plain sight within the financial world. It's a story about numbers, illusions, and how the very metrics we use to judge corporate behavior might actually be totally deceiving us. Today, we're investigating the tax avoidance illusion.
So think about this for a second. Does a changing tax rate actually mean a company changed its tax planning? I mean, it seems super straightforward, right? You see a company's tax rate go up, and you naturally just assume, hey, they are paying more taxes. Or maybe they finally stopped dodging them. But what if I told you that in a lot of cases, that changing tax rate is a complete mirage?
Okay, let's dive right into this. Here is our comprehensive roadmap for the investigation. We'll start by unpacking the tax avoidance illusion itself. Then, we'll look at a really fascinating real-world sting operation, the investor site visit test. From there, we'll break down the math in numerator versus denominator, uncover the truth behind the earnings management link, and wrap up with the broader consequences in the big inference problem.
All right, Section 1, the tax avoidance illusion. For decades, researchers, analysts, literally everyone in finance has heavily relied on a metric called the effective tax rate, or ETR. It's basically used to figure out if a company is avoiding taxes. You just combine the actual cash a company pays in taxes with their reported accounting income. Rate drops, we assume they're dodging taxes. Rate goes up, we assume they're playing fair. It has kind of been the gold standard metric, but, well, it has a fatal flaw.
To expose that flaw, we're cracking open our case file. We're looking at a truly comprehensive 2026 academic study by researchers Zhou, Ma, and Ma from the University of Wollongong. They asked a brilliant question. Do these ETR measures actually reflect real underlying tax behavior, or are they capturing something completely different?
To get what they did, we gotta break down the math. It's actually just a simple fraction. Step 1 is the numerator. Cash taxes paid. That's the hard, cold cash actually leaving the company's bank account. Step 2, the denominator, is pre-tax book income, the profit they report on paper. So here's the kicker. A change in that final tax rate could come from a change in the actual taxes paid, or could come from a change in the reported income. You really want to keep that firmly in mind.
Moving right along to Section 2, the investor site visit test.
The researchers needed a real-world testing ground where corporate reporting pressure suddenly spiked. And they found exactly that in China between 2012 and 2021. Listed firms had to disclose when heavyweight institutional investors, massive mutual funds or pension funds, came to visit their headquarters. Put yourself in the manager's shoes. Pre-visit, you're just doing your normal reporting thing. Then the site visit happens. These huge investors are walking the factory floor asking really tough questions. It's basically a surprise white glove inspection. That intense scrutiny forces managers to dial back their aggressive accounting tactics, both in the short term and the long term. And this setup gave us a brilliant way to test things. They compared two different metrics. On one side, we have cash ETR. That one uses the book income we just talked about, making it highly sensitive to accounting choices, or what the pros call accruals. On the other side, CFO ETR. This one uses operating cash flows instead, so hard money in, hard money out. It is virtually immune to accounting trickery. The researchers tracked exactly what happened to both of these metrics after the big investors showed up.
Let's see what they found in Section 3, numerator versus denominator.
The results from this sting operation were completely staggering. When the investors visited, the book income ETR saw a huge, statistically significant increase. Now, a standard analyst would look at that and say, wow, the visit worked, they stopped dodging taxes. But wait, look at the cash flow ETR, the one that's immune to the accounting tricks. It didn't budge at all.
Literally zero change. Let me repeat that because it's wild. Zero. When they isolated the actual cash taxes paid by these companies following the visits, the change was zero. They didn't pay a single cent more in taxes. Their actual tax planning didn't change one bit. So you gotta wonder, why on earth did the standard tax rate go up?
Well, it turns out it was a total mechanical illusion. The denominator dropped. Remember that math? Because the managers were sweating under the scrutiny of these investors, they stopped artificially inflating their reported profits. So pre-tax book income declined. If you pay the exact same amount of taxes, but you divide it by a smaller income number, mathematically, the overall rate has to go up. It's an illusion. The tax rate looked higher entirely because of accounting changes, not tax changes.
Which brings us to Section 4, the earnings management link.
The real culprit behind the scenes here is something called discretionary accruals. Basically, these are non-cash accounting adjustments. Think of it like a manager deciding to, say, recognize a big chunk of revenue a bit earlier than usual, or maybe they hide a bad debt for a while. It makes the profit look amazing on paper, but it doesn't actually change the cash the business is making. When the big investors arrived, the managers got spooked. They pulled back on these discretionary accruals, and boom, that is exactly why the reported income shrank.
And just to make sure this wasn't some random fluke, the researchers looked at where this illusion was the strongest, and the data lined up perfectly. This fake tax rate bump happened most in firms that historically had high accrual risk, meaning they already had a reputation for getting creative with their accounting. It happened with companies that had weak boards of directors, in opaque information environments, and in non-state-owned enterprises. Put simply, the illusion popped up exactly where managers already had the most wiggle room to play with the numbers in the first place.
Now, what's absolutely fascinating is how the market reacted to this. The researchers tested the earnings response coefficient. That's a fancy way of measuring how much the stock market actually cares about a company's reported earnings. Normally, if a company suddenly reports lower earnings, you'd expect the market to freak out, right? But after these visits, the relationship actually got stronger. The market realized the fluff was gone. They trusted these new, lower, unmanipulated numbers way more. It proves this wasn't just some statistical glitch in a spreadsheet. It was a real economic event the market picked up on.
All right, final stop, section 5, the big inference problem.
There's a quote from the authors that hits the nail on the head. They wrote, "When such measures respond to reporting choices, they may not reliably capture the underlying economic constructs they are intended to measure." This is the big inference problem. Think about it. An entire industry uses the effective tax rate to write news headlines, pass laws, and make massive investment decisions. But if that metric is just dancing to the tune of accounting choices, we're basically making huge decisions based on a mirage.
So what's the big takeaway for us? Number 1, always question accounting-based proxies. Just because a metric is popular doesn't mean it's telling you the whole truth. Number 2, be a detective. Break these metrics down. If a rate changes, ask yourself, is it the numerator changing or just the denominator? And finally, whenever possible, compare accounting results against cold, hard cash flow alternatives. Cash is infinitely harder to fake than a spreadsheet.
Which leaves us with this. The next time you're scrolling and see a headline about some massive corporation's tax rate skyrocketing or plummeting, what are you going to think? Are you going to just accept the illusion and assume their taxes changed? Or are you going to put on your forensic accounting hat, look past the surface, and investigate their actual numbers? The real data's out there, but as we've seen today, you really have to know how to look at it. Thanks so much for joining me for this explainer. Keep asking those great questions, and I'll catch you next time.